Welcome, everybody. I'm Rick Edelman. I'm very excited to have you with us today for what is going to be a very impactful conversation, helping you make the most out of what is universally regarded, and rightfully so, as a pretty rotten year for the financial markets. I'm very happy that you're with us for this event, the greatest advisor opportunity in 14 years. You'll see what we're talking about really shortly. And to help us engage in this conversation, I'm really excited to bring on two very distinguished gentlemen, experts in their own right in this industry. Michael Lane, who is the head of U.S. Wealth Advisory for iShares at Blackrock. Michael, great to have you with us on the program. And Danny Prance, who is the U.S. head of iShares and product consulting, also, of course, with Blackrock. It's great to have both of you with us on the program today.
Thanks, Rick. Great to be here.
The situation that we have right now is, everybody understands what's going on. We have the worst financial markets in 14 years. It's not merely that the stock market's down in a bear market, more than 20% losses in the stock market, even worse in the tech NASDAQ environment. Crypto is down 70% from its highs last November. The real estate market is beginning to falter as well. But what is unusual about this year is that while the stock market is down so much, so is the bond market. And that normally doesn't happen. The last time we saw this occur, where stocks and bonds were both down at the same time and both down double digits, was in the 2008 credit crisis. So it's been 12 years since we have experienced an environment where it doesn't matter what investment you own, odds are pretty good it's gone down in value in 2022. And that is what creates what is the greatest advisor opportunity that we've had in more than a decade, because, we recognize that in a bull market, everybody's a genius. The only question you had to ask yourself over the past decade essentially was, are you going to buy investments that go up or way up? It was kind of all there was to it. And it really didn't take, frankly, a whole lot of genius to end up with a portfolio that performed well. The S&P 500 dramatically outpaced its historic average return of 10% a year since 1926. We have very strong double-digit returns, routinely saw returns of 15% or better over much of the past decade. And with interest rates continuing to climb since 2008, bond values kept on rising. So, hey, what's not to love? Everybody's fat and happy. Look at the real estate market. Look at prices over the past decade. And now that party's kind of over. So what we're finding is that where clients or investors might have said to you as an advisor over the past several years, what do I need you for? I'm doing fine. Thank you very much. Just look at my 401k. Just look at my, self-directed account. Now they get to 2022 and they begin to realize this isn't as easy as they thought. That genius was nothing more than participation in a bull market. And now people are beginning to realize they're not as good at this as they thought. They're beginning to have to explain themselves to their spouses when they got their Q2 statements at the end of June, and now their Q3 statements that have started showing up in mailboxes over the past couple of weeks. They thought they had lost a lot of money at the end of June. Well, wow, look what they lost at the end of September. And they've got some explaining to do to their husbands and wives and partners, as I think they're shocked at not only how much money they've lost this year, but how fast that they've lost it. And there's continuing concern that further losses are coming. The Fed is continuing to raise interest rates. Inflation continues to be a problem. We continue to see economic weakness here and abroad. And of course, we've got the war in Ukraine and COVID lingering, and an election coming up, oh, by the way, in 3 weeks. So we know what's going on in the world, and this is creating trepidation and anxiety and angst among investors and your clients. And this is what is providing for us the greatest opportunity for advisors in 14 years. The opportunity to demonstrate to your client the value that you offer, the judgment, the experience, the hand-holding, and that is what is really so exciting. And so we're really just very happy to have the two of you here to talk about this, because, there are an awful lot of advisors, Michael, we'll start with you, who frankly haven't been in this business more than a decade. This industry is, adding a lot of advisors at a very rapid pace. And for an awful lot of advisors, the last time that we had a down market was before they got into this business. And other advisors are just kind of so used to market volatility, they're not recognizing that this is a tremendous client value opportunity, a tremendous client attraction, a tremendous AUM addition opportunity. Talk about fundamentally how you translate what's happening in the world, what's going on in portfolios into client service, client value.
Yeah, Rick, it is a different, I can't say it's an unprecedented world, but it's a different world than a lot of the financial advisors have experienced. And you do see this bifurcation of those advisors that have been in the business for 10 to 12 years versus those that have maybe been in the business like you and I for 25, 30, 35 years. And not that we've experienced what you were saying, it's been 14 years since we had some of the things that were happening, but you have to go back to the 70s to add inflation on top of all that as well, and having the increasing inflation issue that we have to deal with. So yes, you have increasing yields, but you have inflation at a faster pace than the yields can keep up with. And so it is very different. And like you said, there are so many even in the professional world of asset management in the fixed income side, so many fixed income managers, active managers who just took some credit risk and duration risk, and it worked for a long time, and you could outperform the ag by just taking a couple easy sort of impact investments there with having an extended duration and extended credit. That worked. Now we are in an environment where people are uncertain about duration, and a lot of people are going shorter. Maybe that's the right thing. Maybe it isn't. We don't know what's coming yet. So for the financial advisor community, it is a very challenging year. I think it's going to be a very challenging number of years. I don't think, and I think you would probably agree, I don't think we finish the year, elections are over, and we move on. I think we're going to be struggling through this for a while. And from a financial advisor's perspective, and I started as a financial advisor back in 1989, many years ago. The thing that I'd be looking for on a daily basis is, how do I add value to the relationship I have with the client when I can't necessarily predictably add value in returns, when bonds and stocks, growth, value, everything is not doing well right now. International, you've got potential recession, not potential. There's going to be, everybody's agreeing a pretty deep recession in Europe, a little chaos there today. How do we actually manage the relationship with the clients? And so tax is going to be a big deal. How do we find ways to improve the value we're delivering, the services we're delivering? And a lot of it, I think, fundamentally is going to come down to, how do we take advantage of bad markets, fixed income, equity, domestic, international, and how do we take advantage of that by focusing more on harvesting these losses, which are hard to fathom that that's a good thing to do, but harvest these losses so that we can use those for the future when things do turn around and we do want to sell things and have a capital gain, and be able to use these to leverage not having to pay tax in the future. And so that to me is one of the things that I would be focusing on the most. But yet we still hear many advisors, because they haven't been through these types of experiences, aren't. And that is a challenge, I think, for our industry.
I think you're absolutely right about that. We can't predict the markets, we can't control the markets, but we certainly can control the tax implications of the portfolios that we own. And we can do that in two ways. One is by choosing tax efficient funds, but the other is to take advantage of the churn that this year has created. And Denny, that's what you're seeing an awful lot from these mutual fund products and ETFs, that many investors own products that are grossly tax inefficient compared to others. And if you don't acknowledge it and take advantage of it, you're squandering a massive opportunity to provide tax value to your client.
Yeah, that's right, Rick. Look, last year we saw almost $1 trillion in capital gain distributions go out to investors, really painting a picture of just how critical taxes are. Let me give you a couple numbers which I think are worth highlighting from the impact of taxes. I like to think that taxes are the iceberg, that's the majority is under the water. It's really hard to see. You don't see the impact until the end of the year into January on 1099s. But if you just look at the large cap blend category, so think funds trying to outpace the S&P 500, the average annual tax cost over the last 10 years has been north of 2%. When you compare that against the average fee, it was under 1%. So taxes have in many cases played twice an impact on an investor's portfolio than has fees. And look, we like to scrutinize fees in our industry. We are like down to the basis point scrutinizing, and I think we're missing some of the bigger picture. So what we're trying to do at Blackrock is really paint, what is important for investors to look at when looking at post-tax returns. We like to think pre-tax returns are fool's gold. So the first step is really identifying, where these costs are coming from, and a lot of it is capital gains. And here we are. We're in the middle of fourth quarter. This is when the industry starts to put out capital gain estimates. This is when we start to see the impact of portfolios. And I think this year is going to be kind of a shocker. We're starting to collect some great data across the industry. We're already seeing dozens of managers put out their estimates. We're seeing north of 50% of funds paying out a capital gain. And for those funds, we're seeing that gain almost around 5% of NAV. So think about that. Markets are down. You guys mentioned, you painted a really abysmal picture by the stocks are down, bonds are down, everything's down, and there's nowhere to hide. Yet, there's going to be this disconnect. And I was told, if you want to make things go viral, you got to get a hashtag. So I'm going to call this the hashtag, the Great Disconnect of 2022. Portfolios are down, and advisors are going to have to talk about why taxes and capital gains are coming home. And I think 100% of advisors can explain why markets are down. We know what's going on, but I don't think a lot of clients are fully going to understand why they're paying gains on these. So this is something to put on the radar as we head into deeper into fourth quarter.
So I have two questions that pop up, and you might regard these as basic, but I think we may have a lot of advisors who are not terribly familiar with these issues because it has been so long since we've dealt with them. First, when you talk about how 50% of funds are going to be issuing capital gain distributions, are you specifically referring to mutual funds, or are you also equally referring to ETFs?
Yeah, most of that's in the mutual fund space. If you look out over the last 5 years, we pulled some numbers, but it was something like 71% of funds had paid capital gains. And despite the fact that ETFs account for about a quarter of overall fund assets, only 1% of that's coming from ETFs. So the sizable portion is mostly on the mutual fund side. ETFs tend to be a little bit more tax efficient from structural and strategic reasons.
And we're going to elaborate on that because that's a key point that I think many advisors either don't know or have forgotten, because it's been a long time since we've studied for our Series 65 where all these questions came up. But what we do have, just to put an umbrella over all of this, what it comes down to is that investors pay a lot of attention to how much they pay for their investments. They pay a lot of attention to the expense ratio and loads, but they don't pay attention to tax cost. And that can be so much of a bigger number than the annual expenses. But in that explanation, explain for us, how is it in a year like this, when mutual funds are losing money, how can they be issuing a capital gain distribution? That seems to be a non sequitur. You're losing money, but issuing profits? Explain that.
Well, you're helping me get my hashtag, the Great Disconnect, going here, Rick. And, really, it comes down to, there's some components around mutual fund accounting, when annual report dates are. That's when you have to pay out on those gains. There's a little bit of a lag in timing that happens. We saw this in 2018 when markets were down, not to the extent they are in 2022, but we saw funds paying out cap gains when markets were down. So a lot of it's on the heels of, we went through a decade of pretty strong performance. Like you mentioned, everyone looked good. It wasn't a matter of, positive returns. It was how positive was your return. So we went through a decade of gains inside portfolios across most risk asset classes. And then we started to see some turnover over the last few years, some redemptions out of funds. And really that creates the impact. Cap gains tend to lag market performance. So what we saw this in 2008. Funds were paying capital gain, even though markets were down and down across the board. Mutual fund accounting and fund turnover over the last few years are the two factors that are going to create the hashtag, the disconnect, where funds are going to be down and you'll be seeing capital gains coming home to roost.
And I think that's really the point, isn't it? That the volatility of this year is triggering trading by the funds. Mm-hmm. And it's the trading that turns an unrealized gain or loss into a realized gain or loss, which triggers the capital gain distribution. And since they often held their shares for many years, even though this year the shares are down, they're still profitable from a cost basis perspective over the past several years. And as a result, you end up with a capital gain distribution in a year when the fund itself is down. And it gets compounded by your personal date of ownership. Meaning, if you bought those shares of your mutual fund sometime in 2022, and let's remember back in January, everything was still looking pretty good in January. The markets were still at near all-time highs, and there wasn't a huge worry about what was going on in the world. Things seemed to be doing relatively okay. A lot of people bought shares of their mutual funds in Q1, only to then see the value of those assets fall sharply. So while you may personally be down 20%, you're going to get a capital gain distribution as if you had owned the fund for years.
That's right. And that capital gain distribution is a compounded problem. So not only do you have to potentially have the situation where you have a 20 or 30 or 40% loss in your portfolio and a 5, 10, 15, 20% capital gain distribution, which, you know, if you think about it, if you have $100,000 invested and now you get a tax bill that says you owe tax on $20,000, you know, that was distributed to you. I mean, it's almost like a return of principal to you, but you got to pay tax on it. It is a compounded effect. And what people don't realize, you know, we talk about, you know, Danny mentioned it, you know, 1 or 2 basis points is, you know, will make a difference between somebody buying one product or another in our business. And that 1 basis point on $100,000 is $10. You know, we focus really hard on that. But on that same $100,000 portfolio, even if you only had a 5% capital gain, if you had to pay 30% tax on that for capital gains taxes plus state taxes and the surcharges, depending upon your income, now that's $1,500 that you had to pay, $1,500 versus $10. And we focus more on the $10. And then it gets worse because that $1,500, let's say that you didn't have that money because you had to pay it in tax because you got the capital gain, you're not going to get the compounding effect of that $1,500. So next year, without doing anything, it cost you, if you had a 10% return, another $150. And it just keeps compounding. And that's why we're so focused on trying to help advisors, you know, really zero in on, like you were saying, when did you buy these solutions? What are the capital gain distributions that are being estimated? And try to, you know, get out of the fund and get into something more tax efficient and take that loss if you can and avoid the gain.
We're going to talk further today about how BlackRock offers solutions to all of this for you. So stay with us for that, because you're going to love to hear what BlackRock has to offer. Before we get there, I want to make sure we're completing the comprehension element of this, because it is so devilish. On the one hand, I mean, this can get, Michael, to your point, really, really bad, really, really fast. You invest 100 grand in January, it's down to 75 grand in October. You're going to get maybe a $20,000 capital gain distribution, forcing you to owe taxes of maybe $8,000 between federal and state income taxes. You don't have the 8 grand, so you have to liquidate $8,000 out of the fund. So the $75,000 fund is now down to $65,000, and the shares you sold to come up with the cash to pay the tax are shares that will no longer exist when the markets recover. They're not going to recover, perpetuating the losses that you have lost momentarily. This is just a vicious cycle that it gets worse and worse and worse, all because you picked a fund that is tax inefficient. Because, to your point, Michael, you were worried about the 1 basis point difference in expense ratio instead of the incredible predilection of high capital gain distributions due to high turnover funds, because they're not operating tax efficiently. It's just really poorly done. And your clients didn't understand that, because when they did it on their own, they looked at Morningstar data, or they looked at, you know, what are the best performing funds over the last 5 or 10 years, and they don't realize past performance doesn't equal future results. They don't realize that churn and turnover matters more than expense ratio from a cost perspective. And so here they are. You can bring all this information to the forefront of the client, helping them realize the problem they're facing, the dilemma they're in, and show them a way out, which we're going to elaborate more on today's program. But 2 other things I want to make sure we elaborate on first. First, explain, because you hinted at this, Danny, I want you to elaborate on this. Why is it that this problem tends to occur more in mutual funds than with ETFs. Explain the whole purchase and redemption feature of a mutual fund versus the share creation and destruction feature in an ETF, because that's really the key as to why ETFs are less likely to create this tax problem compared to mutual funds.
Yeah, absolutely. It's definitely worth digging into that because you see some very stark differences in structure here and how that plays a role in taxes. So if I had to try to simplify this, ETFs are really tax efficient for two major reasons. One is the structural aspect of ETFs, and let's hit on that in a second. The other is most ETFs today are generally index strategies. And with index strategies, you generally see lower turnover. So I like to say the strategy of indexing is a tax efficient way to capture the market versus an active strategy, which is buying and selling, a little bit more turnover. So lower turnover equals less churn, less realization of gains. That's sort of the easy one. The structural reason why ETFs are tax efficient is that cash flow for ETFs, so money coming into the fund, and more importantly, money coming out of the fund, is done what's called through an in-kind transfer. That's effectively a transferring of the assets in kind. That is a non-taxable event. With mutual funds, by contrast, most creations are done in cash. So cash is given to the mutual fund manager. And on the redemption side, investors want cash. So cash is distributed out. Buying and selling occurs within a fund for a mutual fund. Buying and selling of an ETF occurs on an exchange. For example, if Michael was selling his S&P 500 ETF and I was buying, we would meet in the market and no cash flow takes place inside the fund. Conversely, if he was selling it, he would find a seller in the market. Again, no cash flow takes place within the fund. So the ETF structure has done a really good job of insulating other investors from other activities. And I'll give you an example, and this happened to me last week. I was in New York having dinner with colleagues, and I showed up to dinner a little bit late. They'd already had a cocktail. They had some good food. I wasn't hungry. I had salad. When the bill came, we all split it. And that's sort of how a mutual fund is. Every implication of every investor will get pro rata portion. And in an ETF structure, I would have paid for my salad. You would pay your own freight essentially. So really, the ETF structure has insulated the investor. It has insulated me as buying the salad from other investors' activities. And the net result is this. At the end of the year, you generally see either no capital gain distributions or very little capital gain distributions when comparing against a mutual fund in the same category. This is one of the reasons why ETFs have gone mainstream over the last 10, 15 years, is this notion that taxable investors are getting smarter about taxes. They're really connecting the dots between what happens in investing world, that what happens on the 1099 and how that impacts investors. It's the low cost of indexing. We're noticing performance has been fairly strong, but it's really this tax angle that we're super aware of during fourth quarter. So really the structure of ETFs and the strategy of indexing is what contributes to tax efficiency.
So it's a really important point that you're making, Danny. And the takeaway is simply this. Due to the way these products are structured under the law, mutual funds are inherently less tax efficient than ETFs. It's really that simple. So you're setting yourself up for this kind of a tax problem when you own a mutual fund compared to when you own an ETF. Now, it can vary to some degree depending on the type of funds you own, but the bottom line is structurally, legislatively, this is the issue and why ETFs are so much more popular. And I talked about how this is a conundrum if you bought your shares in January and then you lost money in this year. But it gets particularly astonishing if you bought your shares in October. And that's because of the most important fact within all of this issue called the record date. So Michael, explain for us what the record date is, why advisors must pay so much attention to it.
Yeah, Rick, and that's one of the things that, and we'll talk about it, that the tool that we've created to help advisors, it pays close attention to the record date, because if you own the shares as of the record date, you're going to collect that distribution. Whether you want it or not, it's going to be paid to you. And so you want to If you want to avoid that capital gain, you want to sell before the record date. You want to be out of the fund before the record date. That record date, as soon as that date hits, if you're a shareholder and you bought the fund the day before and it's paying a 10% distribution, capital gain distribution, you're going to get paid that, and that's going to be a challenge. And those are typically, it used to be they were always just kind of paid around December, but that's one of the things that's happened in our industry as well. Is a lot of firms, so that they don't have as big a capital gain distributions in December, they're paying them out a lot of times in mid-year as well. So they're paying 2 capital gains. They'll do one in May, June, July sometime, and then they'll do another in December. It'll look like less distribution then at the end of the year, when in actuality, you're going to get a bigger tax bill because you probably didn't pay attention to the fact that you got a capital gain distribution in July. And so one of the other things that we are focusing on is instead of just this being a fourth quarter issue, this really is a year-round issue now. And it's something that, particularly if you own less tax efficient vehicles like a mutual fund structure versus an ETF structure, you can't just look at this in December anymore. You have to start looking at this, starting really in March all the way through the end of the year.
And so here we are, we haven't done that, or we've lost our opportunity to do that, because here we are in late October. We're coming up on year end. The record date is going to be arriving in November or December, depending on the fund. And it's going to be anywhere from, a low distribution percentage of NAV, or it could be double digits of NAV. Some of these funds are going to issue 20-30% distributions, which is going to shock an awful lot of investors. So let's talk about BlackRock's tax tool, because advisors are really struggling with 2 things. Number one, how do you anticipate, how do you calculate what the capital gain distribution is likely to be? And what do you do about it? What strategy can you engage in to help mitigate the problem? So Danny or Michael, whichever one of you wants to tackle the BlackRock tax tool, let's talk about that.
Yeah, I'd love to talk about that, because, this is one of those things where we talk about the disconnect in our industry. You don't really see the impact of taxes pretty clearly, but this is like one time in our industry where you get information in advance. Like, I don't know what the market's going to do tomorrow, right? I don't know what the Fed, we all sort of have ideas and we sort of put out our best guess, but this is the one time in investing where we actually get a recipe of what's happening in the future. And so, for me, knowledge is power here. It's about taking advantage of that information. Traditionally, mutual fund companies, ETFs, and mutual funds put out capital gain estimates, usually on the website, or they'll email out to advisors, to clients. What we're trying to do here is take that information, put it in one place, so that everyone can see with scale, what the landscape looks like across the entire fund industry. And that's what the BlackRock Tax Evaluator is doing. So that's something that you can Google today. The BlackRock Tax Evaluator is on our Advisor Center website for BlackRock. It's a tool that we put together to make sure that taxes and what's happening is front and center. Now, in that tool, you can easily upload your portfolio. It's a copy and a paste of tickers. We'll let you know the capital gain estimates that we're seeing, the dates of those capital gains, the magnitude of those capital gains. We'll also showcase what's the impact to a portfolio. How much would that cost the investor? We also leverage that tool, the ability to start reducing taxes. It's funny, Rick, I get introduced in a lot of these webinars like the tax man. And when my message is very clear is, I'm not the tax man, I'm the tax reduction task force. And my goal here is someone who lives in California, who has some of the highest marginal rates, to make sure within the rules of law, we don't have to pay 1 extra cent of what we don't have to do by law. And what the BlackRock Tax Evaluator will do is just that. It'll help you identify what funds you have in your book that are paying across the industry, when that's occurring, and potential swap opportunities. We also talked about, really the 2 opportunities right now in fourth quarter are getting in front of these capital gains that I just alluded to. And we just spoke about this big disconnect. You're going to see capital gains in a year where you're down. And tax loss harvesting. We have added functionality to this tool over the last few years, such that it can also help you identify where in your portfolio you might have losses. So again, 2 strategies: be aware and get in front of and potentially trade in for out of capital gains. And then the other is identify tax loss harvesting opportunities such that you can bank tax offsets for the future. You can offset some ordinary income in the future. You can keep those in perpetuity. but you want to stay invested. So we help you identify them and help you map into something that provides you similar exposure, but you need to be mindful of navigating the wash sale rule. So a great tool, maybe that's the name's not the best, right? The Blackrock Tax Evaluator, but it's a great tool to help you see your portfolio in one place, save you time. You don't need to go to multiple places, and you can help you identify these two strategies to help you do something and control, this environment.
So the BlackRock Tax Evaluator has one of the biggest benefits. I've used the tool. I love it. It is really, really efficient. Is that fact? We all own so many different ETFs and mutual funds from so many different providers. It's such a pain to go to everyone's website, go talk to all those wholesalers, try to find the data. You've solved all that. One click, there it is, a complete list. You can enter into the tool the client portfolio, just the list of investments, and up pops, here's the record date, here's the expected estimated amount of distribution. It makes life so much simpler, so much easier, so that you aren't wasting your time fussing with data. You can spend most of your time doing analysis on behalf of the client. But there's really one important element to this, Danny, that I want to make sure we emphasize. It's one thing to discover the record date, the size of the distribution. And you can easily say, I'm going to sell those shares in order to avoid that record date. But that takes you out of the market. And with your dumb luck, the market will rise the day after you sell. We're all Louis the loser in that regard, aren't we? With our lousy market timing. So the trick is to not sell and sit. The key is to sell those shares and then rebuy, but you can't rebuy the same exact shares. The IRS says, this is called the wash sale rule. You're not allowed to rebuy the identical shares you just sold. Michael, I want you to explain the wash sale rule and explain what we do to get around it or to deal within that rule. So talk about the wash sale rule, because it's a key element, the second half of this strategy.
It is a key element, and I saw a couple of questions coming up about the whole wash sale rule and the importance of it. And the challenge is, if you, like you were saying, if you sell something and then buy something materially similar that has the same securities inside of it, there's a high degree of probability that you're going to have a wash sale rule, which means that you lose that ability to take the loss. You basically, within 30 days, if you do that, it's like you never had a transaction. I mean, it basically deletes the transaction in that sense from a loss perspective. So you forego that loss. So one of the things that you want to make sure is that if you're going to swap from one investment to another investment during that 30-day period, you want to make sure, especially if you're trying to maintain an exposure, you're trying to maintain the portfolio exposure that you want, that meets the risk tolerance or it aligns with the goals you're trying to achieve. When you sell out of, let's say, a mutual fund that is large value, and you want to buy an ETF, let's say, that is also exposed to large value, you want to make sure that you have a high correlation of those two investments so that they move in, their prices move similarly, but you want to reduce the overlapping securities as much as possible so that you have a low probability of a wash sale rule. So this correlation calculator that we created enables you to go in and put in the investment that you're looking to sell, and then it'll look at all of the similar type of investments, say from iShares, that would be investments that you could trade and swap for within 30 days, and it would tell you what the correlation is. So a high R squared, something that's a 0.97, 0.98, that would be great. That's going to give you similar returns based on that. But maybe it only has a 20% or a 30% or a 40% overlap of the underlying securities. That's a good probability that you're not going to have a wash sale rule. If you see a high correlation and you have 100% overlap, very good probability that you're going to have a problem. You're going to have a wash sale. And so there's, other issues around, dividend payments, when those get paid, when you sell. There's some things I saw in the Q&A that you do have to be careful, because if you sell and a dividend's paid, that can also wash portion of your sale. So you do want to be careful of when dividends are paid. Again, record date is an important date for consideration to make sure that you're doing this in a way that you don't wash out any of the harvesting that we are suggesting is a good idea for most people. So that's the correlation calculator. That's the wash sell rule. It doesn't do you any good if you sell out of one investment and buy another investment that looks just like it, and then the next day you're probably going to wash out that tax loss harvest.
And so that's really the key to understand, is that it's a two-step process. First is selling the fund or selling the shares to avoid the record date, but then to make sure you're not out of the market, buying something else that allows you to remain your exposure without running afoul of the wash sale rule. So it's a two-step process that you really need to observe. And that's really a key element of this. We're getting a lot of folks who want us to say again the name of the tool and how people can find it. So Michael, I'll let you do that again.
Yeah, a lot of times it's called the Blackrock Tax Evaluator tool, and then there's the Blackrock Correlation Calculator. The easiest way for me to find it when I'm trying to find it in a hurry is just to Google that, Blackrock Tax Evaluator tool, and it pops right up. And same thing, Blackrock Correlation Calculator will pop right back up at the top of your screen. So that's the easiest way, is just Google those two, and you'll find it easily.
And is this tool exclusively for advisors? Is it also available for individual investors?
Danny, actually, that's a question. I believe it's just for financial advisors through our advisor center. But Danny, why don't you confirm that?
Yeah, no, that's confirmed. It sits on our Blackrock Advisor Center for financial professional use.
And I think that's really important to understand for two reasons. One, this is a complicated conversation, and it requires a certain amount of sophistication and expertise, which you can expect advisors to have. And I'm not so confident ordinary investors would be. I don't mind a surgeon holding a scalpel. I don't think I'd want to hold it myself. So that's one important element. Second, this is a reinforcement of a fundamental principle that I've observed over the years about BlackRock and iShares that is worth highlighting. BlackRock and iShares caters to advisors. I mean, it's really interesting. You're the largest ETF provider in the industry. BlackRock itself, of course, the world's largest money manager with, what is it, $8-9 trillion in assets these days. And yet it's really not a household name for the simple reason that you're really not running ads during the Super Bowl. You're not really trying to market to individual investors the way other fund providers do, because you recognize that the value here is for the advisor, helping the advisor serve the investor instead of you serving the investor directly. And the fact that you've gone to the trouble to create this highly sophisticated, comprehensive tool, and then saying, we're only making it available to advisors, is really a message to investors. You really need to be working with an advisor. Don't try surgery at home, hire a surgeon. And your advisor has a capability of delivering a service to you that you can't replicate individually by yourself. It really does demonstrate the value of an advisor. And there aren't very many fund companies that make that statement so clearly. Advisors, we're supporting you, and we're not going to compete with you by also equally supporting investors directly. And I think that's a really important message on a corporate culture that BlackRock and iShares have made very clearly. And I think that not every advisor fully appreciates that fact, because so many other fund companies, quite frankly, compete with advisors because they're happy to do direct communication. And every tool they give an advisor is, oh, by the way, available to investors as well. You don't do that.
No, and it's such a good important point, Rick, because it also goes to when people, most people don't know the BlackRock name, but maybe sometimes when they do hear the BlackRock name, they don't hear it in the right light either. And that's one of the big issues for us on a day-to-day basis is people think that we're managing the people's asset allocation like maybe other asset managers will do, and they'll give advice and give guidance. We don't. And what you said is exactly right. This is not our money. This is a client's money who have largely turned over discretion to manage that money to a professional financial advisor. And they've chosen to use BlackRock building blocks to build portfolios. We don't control the money. We don't own the money. We don't have discretion over the vast majority of this money. It is controlled and managed by professional financial advisors. And that's such an important point, because there are a lot of people that will suggest that we are trying to persuade people one way or the other of how to invest. And we just make choice available so financial advisors sitting with the client can make that decision.
Danny, anything you want to add?
No, I would just echo what Michael said. Look, Michael's in Texas and I'm in California. We have different tax rates to contend with, but BlackRock is really thinking about this as a fiduciary and really thinking about the best experience for investors and really leaning into sort of that idea that markets are scary. Rick, like what you said, if we stay out of the market, it's probably going to rally. It's really hard to predict markets. It's about guidance. It's about doing sophisticated strategies. And, really leaning into a financial advisor there is great. Look, you mentioned it. We're the #1 ETF provider. We have almost 400 solutions. We see ourselves as great at making choice available. We see ourselves as great at trying to unlock value, like building the BlackRock Tax Evaluator. But we think our clients, financial advisors, are great at helping navigate markets and helping their clients stay invested. So, that's really our value proposition. We want to give the toolkit. We want to give and empower through technology and tools. But ultimately, the power of financial advice is one that every investor can really benefit from.
So let's talk a little bit about the details of executing a tax loss harvesting strategy. You alluded to one, Michael, a moment ago. And by the way, in your chat, we have now posted the link. So the URL directly into BlackRock's website is in the chat at the bottom of your screen, so saves you the Google search. You alluded to this, Michael, momentarily, and I want you to elaborate. A very common strategy for investors and advisors is to reinvest dividends and capital gains. So what happens if maybe I bought my fund years ago, but I'm reinvesting dividends and capital gains, including dividends that have been paid this year? What impact does that have on the strategy regarding the wash sale rule?
So it can have an impact on the wash sale rule. One of the other big impacts that people don't realize is the difference between price return and total return. And so when they receive dividends and they receive capital gains, and when that is a component of a total return of a portfolio. And so when somebody looks at their investment and they look at their performance report for their investment, they may see that over the last 3 years, their fixed income investment, their bond investment returned 2% or 3%, even in this environment, because that included dividends. If you take that out, the price return of that fund may be -8%, maybe -9%, which is what gives you the ability to have the opportunity to take a loss on that. So even though your total return may be positive, don't be misled that means you can't take a tax loss on the price return. And so Danny can elaborate more on that, but price return and total return are something that are very important, and dividends and capital gain distributions are part of total return, not price return. And so that's one component. When you think about dividends, if you are, and I've had this happen, where I made a sale on something, and as I was making a sale, I was reinvesting a dividend, and whatever that reinvested dividend was, if it was within the 30 days of the sale I made, it washed out a portion of that loss that I may have been taking, because of the fact that there was a buy and sell for those number of shares at the same time. And so you do want to also be very aware of when dividend capital gain distributions are being made. And a lot of times we see people will trade pre 30 days or post 30 days if they're around whatever the record date might be, just to also avoid some of the, especially if they're large dividends being paid, very high yielding investments. You want to be careful not to wash out any of the loss harvest that you may have an opportunity. So that again is going to be something where most individual consumers, most individual investors, that's going to be a complicated analysis for them. But as financial advisors, that's something that we do every day.
And I think related to all of this, even if you aren't going to engage in the strategy, and you may have reasons, or your client may have reasons, knowing what these capital gain distributions are going to be can be very helpful for year-end tax planning purposes. And if you were able simply to provide this info to your client that they can share with their tax advisor, this can be a tremendous value add to the client. So whether or not you're going to actually take action is separate from you having a conversation with your client and letting them know what's going on, because the worst thing that could happen as a result is that you take no action, you don't discuss it with your client, nobody pays much attention to this, and in January, your client gets one hell of a 1099. And if you think the client's annoyed at losing 25% this year, just wait till they find out that they owe taxes on 20% of the fund. You really need to have the conversation, and the tax evaluator tool gives you the content, the data, so that you can have a meaningful conversation with your client, their tax advisor, and show value add, especially if you integrate with direct communication with that advisor, the tax advisor, because their other clients are not hearing from their other advisors. It's a wonderful way for you to show value add, that you are providing services that are better than other advisors are. It's a wonderful way to win referral business in an environment like this, which goes back to the theme of this conversation, the biggest advisor opportunity in 14 years. Danny, talk about, though, the flip side of this. What's the downside of doing tax loss harvesting? What are the negative side effects?
Yeah, well, look, one of the sort of downsides of tax loss harvesting is you're effectively resetting your cost basis. So, if you think, like you had an asset that was at 100, it's down now to 80, you maybe bought it at 100, you have a $20 loss, your basis gets reset down to 80. And, if it goes back up to 100, you have a $20 cap gain, where if you didn't do tax loss harvesting, you would have no gain effectively. So there is sort of an implication, you reset your basis. But I like to say that, taking a tax loss harvest now, you can always keep those losses in perpetuity for future gains. So back in 2003, there was a change in how long you can keep losses. And it is now, losses can be kept in perpetuity. So if you don't have any gains this year, you can use them for future gains. So I like to say, the downside is really resetting your basis, but a bird in the hand is worth more than one bird in the bush. You kind of take that now. You can always offset it in the future, right? So there's that. The other is, let's say you harvested into something different. And, Rick, maybe we have the same luck, but like I go do something else, and all of a sudden the thing that I went from is doing better than what I did. And I'm kind of like, scrambling, like, why do I always make those decisions? Like, investing never feels good, right? You should be buying low and selling high. It never feels great. But, the other risk is you tax loss harvest into the wrong thing. You go from, a small cap value fund, you buy one or two stocks to harvest into. Those stocks don't do well, and what you originally had did. That's like the sort of unlucky side of tax loss harvesting. What we want to do is, again, to Michael's point, get in something that's going to keep you invested in the same strategy. Our message to investors right now is, look, don't change. If you had a plan 2 weeks ago, don't change your plan. Keep your plan, but take advantage of this value that could be kept in perpetuity and offset taxes as you go along. Again, a bird in the hand is worth more than one bird in the bush. So that's really your downsides and considerations you want to be mindful for.
Yeah, and Danny, to build on that, one of the things that we do see sometimes is somebody will go from a very concentrated portfolio or even single security, tax loss harvest out of that. And typically when you have concentrated portfolios or single securities, those are much more volatile than if you have a diversified portfolio that you may be buying in replace of that. And that's where you could have a very volatile individual security that might move 4 or 5% in one day, while the ETF that you bought to replace that with, to avoid the wash sell rule, maybe that's only going to move 1% for the same type of movement in the market. And depending upon which way that goes, you may feel great about it, or you may not feel so good if all of a sudden markets went on a tear. And that's one of the things that we stress with people too, is like staying invested. I know, Rick, this is a huge component of what has made you successful over the last 30 plus years, is stay invested, stay diversified. Super important for people to know. We had a financial advisor recently that, was losing their will to stay invested. They were starting to think about going to cash. And that was on a Sunday that I got a call. Monday and Tuesday of that week, markets were up 6%. If you had bailed on the beginning of the day on Monday, most likely what would have happened, human nature, is by Tuesday night, you were back in again. You had lost 6%. And then of course, markets didn't do well for the next 2 days, and so you would have not only missed the 6%, you would have then compounded it by being back in and just catching the downside. And so that's where staying invested, staying diversified, being really careful with individual security volatility relative to ETF highly diversified volatility is important during these tax trades.
You're exactly right. And we're all human creatures. We're emotional. We're not analytical in our behaviors. No matter how smart we are, we react emotionally, and that gets in our way, gets in our client's way, which is why we need to be dispassionate and objective. uh, disinterested, not uninterested. And what I often find is that in a moment like this, a year like this, advisors are often reticent to contact their client. They hesitate, they're reluctant because they're afraid that the client's going to yell at them. They're afraid that the client might fire them because, you know, you gave me this investment and I just lost 25% and I'm blaming you. And advisors don't want to hear that. They don't want to risk the wrath. You know, let's just hope my client isn't noticing any of this. And I don't want to, you know, take the heat. That's the wrong positioning. In an environment like this, what we need to recognize is that the way you position yourself with your client is key. In other words, there are three players here. There's you, the client, and the market. What many advisors do is that they align themselves with the market. This is the investment I want you to buy. This is the strategy I want you to take. This is my belief of the market. And it's you and the market versus your client. Well, naturally, if the client is unhappy with the market, they'll therefore be unhappy with you because you've aligned yourself with the market. Instead, take the position with your client, Mr. or Mrs. Client, it's you and me against the market. So as your client is unhappy at losing 25% in their stock funds this year, that's the message you give them. You call them on the phone and you say, I'm as angry as you about that lousy market. I'm as unhappy with you about Putin. I'm as disappointed as you about COVID. I'm as unhappy as you as A, B, C, D, E, F, G. And what you and I are going to do together is win the war against the market turmoil. If you position yourself and align yourself with your client, as opposed to aligning yourself with the market, your client will maintain allegiance to you as you and your client together work out a strategy to minimizing the issue. So we're mad at the market. We're going to minimize it by doing tax loss harvesting and make lemonade out of lemons, positioning ourselves for the long term. That's how you preserve and enhance your client relationship. And by using the kinds of tools and the investment opportunities that BlackRock offers through iShares and these analytical tools at the Advisor Center, that's how you win client loyalty. That's how you gain market share and greater share of wallet. And this is a strategy that many advisors forget in a year like this.
Yeah, Rick, it's so interesting to hear you say that because it doesn't just apply to how you manage relationships with your clients. It's how you manage your relationship with your kids, your spouse, your friends. At the end of the day, like if we just all would get on the same side of the table and look at the problems on the other side of the table and work together to solve those instead of attacking and establishing that maybe you're going to be the solution to those problems. Like you're not the solution to the problem. The problem is the problem, but how are we going to solve it together? And that I have learned in my my few years in this business to take how what has worked for my 35 years of being with the same woman to our business as well. Is it makes a lot of sense not to try to be on the opposite sides of an argument, but instead look at the problem on the other side of the table together.
And with the right partners, Michael, as you've laid out, your likelihood of success will increase and enhance, and your ability to shine will do a lot better. Recognize in an environment like this, an awful lot of advisors are inexperienced. They're not getting good direction from their firms. They don't really know what to do in a down market that they've never experienced like this, and they aren't calling their client. This is an opportunity for you to reach out, be proactive, provide opportunities for strategies that will remind the client and reassure them that you're competent and that you're dedicated and focused on their best interest. And this is an opportunity we haven't had in 14 years. And as Michael said, on an inflation basis, in about 50 years. That's why this is a huge opportunity for building your business. Don't blow it. This is going to go away soon. At the end of the year, it's gone. So this is something timely for you to take advantage of. Danny, any final thoughts?
No, Rick, I'd just like to piggyback on what you just said. You know, if you think about planes, they take off into headwinds. And, you know, this is an opportunity in this environment where it doesn't feel like there's a lot of action today. This is the time to take some action. And there is something you can control, and it's not going to be markets, and it's not going to be the Fed. So you need to let that go. But what you can control is what has been the biggest cost in the taxable person's portfolio, and that's the impact of taxes. The best advisors I work with are probably doing that this year.
So this is a wonderful opportunity. We hope you'll take full advantage of it, make those lemons into lemonade, and with luck, we'll get through this before the end of 23. That's, I think, everybody's wish. Michael Lane, the head of iShares U.S. Wealth Advisory for BlackRock, and Daniel Prince, the head of iShares Product Consulting and Core Style Box ETFs at BlackRock. You can reach them and your colleagues at blackrock.com and the tax evaluator tool at the URL in your chat. I'm Rick Edelman. Thanks, gentlemen, for joining us on this event. I'm really glad that we spent this time, and I think we've really helped a lot of advisors in turn help their clients. And I want to encourage you to join us for our next webinar, which is going to be on November 7th. 2 to 3 p.m. Eastern, investing in global crypto industry via the picks and shovels route, not buying Bitcoin, not buying digital assets, but by investing in the companies that are helping to build this technological innovation. It's going to be November 2nd, 2 p.m. Eastern, online as a webinar, 1 CE credit. You can register at dacfp.com. And to learn more about blockchain and digital assets, I strongly encourage you to get your certificate in these subjects, an online self-study, self-paced course, 13 CE credits, teaching you all about digital assets, plus the investment thesis and how to talk to clients about this and build your business with digital assets technology. And I encourage you to read my new book, #1 Amazon bestseller, The Truth About Crypto. If we can be helpful to you, let us know. That's what we do here at DAC-FP, is give you the content, education, information you need to do a better job with your clients. I'm Rick Edelman. Thanks for joining us on this program. Have a great week.